Ladies and gentlemen, let me start with a question that cuts straight to the heart of our moment. What happens when the engine of credit, the fuel of modern economies, suddenly runs dry? Today, we are witnessing a liquidity freeze where major dealers are maxed out on credit, confidence is tightening, and the silver capital crisis is no longer a distant warning, but a present reality. This is not just a financial headline, it is a defining test of resilience, leadership, and vision. The deepening liquidity freeze is rapidly becoming one of the most defining stress signals in today's financial environment, as major dealers across markets are reaching, and in many cases exceeding, their credit limits. This development is not simply a technical constraint within balance sheets. It represents a fundamental slowdown in the circulation of capital that underpins trading, lending, and market confidence. When institutions that traditionally act as liquidity providers begin to pull back, the impact ripples far beyond their own operations, tightening conditions for corporates, investors, and even sovereign borrowers. The question now confronting markets is not whether liquidity is constrained, but how long this pressure can persist before it reshapes financial behavior at a systemic level. At the core of this freeze is the reality that credit capacity is finite, even in an era long defined by accommodative policy and abundant leverage. Dealers maxed out on credit are being forced to prioritize balance sheet preservation over market-making activity, reducing their willingness to absorb risk or intermediate trades. This shift creates a self-reinforcing loop. As liquidity thins, price discovery becomes more volatile, spreads widen, and counterparties demand higher premiums for participation. What begins as a funding issue quickly evolves into a confidence issue, and confidence, once shaken, is notoriously difficult to restore. The professional concern lies in how rapidly these conditions can escalate. Liquidity rarely disappears overnight. It erodes quietly, then suddenly, one day markets function with friction. The next day transactions stall. This is the hook that demands attention. When credit lines tighten simultaneously across multiple institutions, the system loses its shock absorbers. Small disruptions that would normally be contained begin to travel, turning isolated stress into broader market instability. Yet this moment also exposes an uncomfortable truth. Years of aggressive leverage and compressed risk pricing have left limited room for maneuver. As dealers step back, participants are forced to confront the true cost of capital and the discipline it demands. This recalibration, while painful, serves as a necessary reminder that sustainable liquidity is built on prudent risk management, not perpetual expansion. What makes the current liquidity freeze particularly compelling is its timing. It arrives at a moment when markets are highly interconnected, information moves instantly, and sentiment can shift globally in minutes. In such an environment, credit saturation is no longer a background concern, it is a headline risk. Those who recognize this early are not just observing a crisis unfold, they are witnessing a pivotal inflection point that will redefine how liquidity, credit, and trust are valued in the financial system. The emergence of the silver capital crisis has drawn sharp attention to structural weaknesses that were quietly building beneath the surface during years of easy money and aggressive capital deployment. What makes this moment particularly striking is not the suddenness of stress, but the realization that many institutions were operating on assumptions that no longer hold. Capital was treated as endlessly available, risk as easily transferable, and liquidity as a permanent feature rather than a conditional privilege. The crisis has shattered those assumptions, forcing markets to confront a more disciplined and unforgiving reality. But at its core, the silver capital crisis reflects a misalignment between risk appetite and risk capacity. Capital flowed freely into crowded trades, complex instruments, and leveraged strategies that performed well under stable conditions, but offered little resilience under stress. When volatility returned and funding costs rose, the fragility of these positions became visible almost instantly. This is the hook that demands serious attention. Strategies that looked sophisticated in abundance proved vulnerable in scarcity, revealing how quickly confidence can evaporate when capital efficiency replaces capital prudence. Professional observers note that this crisis is not confined to a single asset class or institution. It is systemic in nature, rooted in a global environment where yield compression encouraged increasingly aggressive behavior. As capital became cheaper, standards weakened, leverage crept higher, risk buffers thinned, and diversification was often assumed rather than tested. The silver capital crisis now exposes these blind spots, highlighting how interconnected balance sheets amplify stress when even one segment falters. What makes the situation more compelling is the role of behavioral complacency. Extended periods of stability condition decision-makers to underestimate tail risks and overestimate liquidity, underestimate pressure models built on historical calm failed to account for synchronized withdrawals of capital. When stress arrived, it arrived everywhere at once. This moment serves as a powerful reminder that markets do not reward optimism alone, they reward preparedness. Yet within this disruption lies a critical inflection point. The crisis is forcing a reassessment of capital discipline, governance, and transparency. Institutions are being compelled to reevaluate how capital is allocated, how risks are priced, and how resilience is measured. This recalibration is uncomfortable but necessary. The silver capital crisis is not merely exposing excess, it is redefining what sustainable growth truly requires in a modern financial system where capital must once again earn trust, not just returns. Market confidence is increasingly under pressure as tightening liquidity reshapes behavior across financial systems, turning caution into a dominant force. Confidence, unlike capital, cannot be injected overnight. It is built gradually and lost suddenly as funding conditions tighten. Investors and institutions alike are reassessing not just risk exposure, but the reliability of the market itself. When participants begin to question whether liquidity will be available tomorrow, today's decisions become defensive, restrained, and reactive. This shift in mindset is one of the earliest and most powerful signals of deeper stress. The immediate impact is visible in reduced risk appetite. Institutions that once competed aggressively for yield are now prioritizing capital preservation, shortening time horizons, and limiting exposure to anything perceived as uncertain. This is the hook that matters. When confidence weakens, even fundamentally sound assets can be sidelined. Volatility rises not because values have vanished, but because conviction has. Prices begin to move on sentiment rather than fundamentals, amplifying swings and eroding trust in market signals. As liquidity tightens, volatility becomes self-reinforcing. Wider bid-ask spreads reflect hesitation among market makers, while lower trading volumes reduce the ability to absorb shocks. Each abrupt price movement reinforces the perception of instability, prompting further withdrawals of capital. This feedback loop places stress on institutions that rely on orderly markets to manage portfolios and meet obligations. The result is a market environment where uncertainty is priced at a premium and participation becomes selective rather than broad-based. Reassessment of balance sheet strength is now central to decision-making. Counterparty risk, once an abstract consideration, has moved to the forefront. Institutions are scrutinizing exposure not only to assets, but to the financial health of those on the other side of transactions. This heightened scrutiny slows activity and increases friction, but it also reflects a deeper recalibration of trust. Markets function on confidence as much as on capital, and when that confidence erodes, efficiency declines. What makes the current pressure on confidence particularly significant is its speed and reach. In a globally interconnected system, sentiment travels faster than fundamentals. A localized concern can become a global hesitation within hours. The critical question now facing markets is not whether volatility will persist, but whether confidence can stabilize before caution hardens into paralysis. In moments like this, confidence is no longer a passive byproduct of growth. It becomes the most valuable asset in the system, fiercely guarded and cautiously deployed. Rising signals of systemic risk are becoming impossible to ignore as credit saturation among major dealers exposes vulnerabilities that extend far beyond individual institutions when core market intermediaries begin to operate at the edge of their capacity. The concern is no longer isolated balance sheet stress, but the resilience of the entire financial architecture. Systemic risk does not announce itself loudly at first. It whispers through tightening funding conditions, delayed settlements, and a growing reluctance to take on exposure. The hook lies here. By the time systemic risk is obvious, it is often already entrenched. Credit saturation acts as an early warning mechanism because major dealers serve as the connective tissue of financial markets. They absorb shocks, provide liquidity, and facilitate the smooth transfer of risk. When these entities are constrained, the system loses its ability to self-correct. Small disruptions that would normally be contained begin to propagate, crossing asset classes and geographic boundaries. What appears manageable in isolation becomes destabilizing in combination, particularly when multiple institutions face similar constraints simultaneously. The professional concern is compounded by the interconnected nature of modern finance. Balance sheets are linked through derivatives, funding markets, and collateral chains that rely on continuous confidence and lack availability of credit. When one link weakens, pressure transfers rapidly to others. This is where systemic risk quietly accelerates. Margin calls increase, collateral values are questioned, and funding costs rise in tandem. Each reaction, rational on its own, contributes to a broader tightening that affects the entire market ecosystem. What makes these signals especially compelling is their timing. They are emerging in an environment already shaped by elevated leverage, compressed margins, and heightened sensitivity to shocks. Credit saturation under such conditions reduces the margin for error. There is less capacity to absorb surprises, less tolerance for volatility, and less room for policy or institutional delay. The question markets are now forced to confront is unsettling. How much stress can the system absorb before normal market function is impaired? Yet systemic risk is not solely about fragility. It is also about awareness. These warning signs offer a rare opportunity for corrective action before disruption becomes disorder. They challenge institutions and regulators alike to reassess capital buffers, stress testing assumptions, and the true liquidity of assets under pressure. The most dangerous aspect of systemic risk is not its presence, but its dismissal. When credit saturation is viewed as a temporary inconvenience rather than a structural signal, the cost of inaction multiplies. In this moment, the rise in systemic risk signals is not a prediction of collapse, but a demand for vigilance, discipline, and decisive leadership. The call for strategic leadership is growing louder as financial markets navigate an environment defined by constraint rather than abundance. In periods of stress, leadership is no longer measured by aggressive expansion or short-term performance, but the ability to impose discipline, clarity, and confidence. When uncertainty dominates, this is the moment that separates managers from leaders. When liquidity tightens and volatility rises, markets so look not for reassurance in words, but for credibility in action. The hook is unmistakable. In times of crisis, indecision becomes a risk in itself. Strategic leadership now demands a return to fundamentals, disciplined risk management, transparent communication, and long-term thinking that resists the pressure of immediate gratification. Institutions are being forced to reassess how risk is identified, priced, and governed across their operations. Assumptions that once supported leverage and rapid growth must be challenged, stress-tested, and where necessary. Abandoned? This process is neither quick nor comfortable, but it is essential. Without it, confidence cannot be rebuilt, and without confidence, capital will remain cautious and constrained. Transparency has become a central pillar of leadership credibility. Markets are increasingly intolerant of opacity, particularly when balance sheet stress is suspected. Leaders who communicate clearly, acknowledging risks without exaggeration and outlining realistic responses, are better positioned to stabilize stakeholder trust. Silence, delay, or overly optimistic narratives now raise more concern than reassurance. The message is clear. Trust is no longer granted by reputation alone. It must be continuously earned through openness and accountability. Long-term planning has also re-emerged as a defining leadership requirement. Strategic leaders are shifting focus from quarterly outcomes to structural resilience, prioritizing capital strength, liquidity buffers, and sustainable business models. This shift challenges cultures built around short-term performance metrics, but it also lays the groundwork for durability in uncertain conditions. The real hook here is that resilience, once viewed as a defensive posture, is now a competitive advantage. What makes this call to leadership particularly urgent is the speed at which market sentiment can deteriorate. In a highly interconnected system, hesitation at the top can cascade into hesitation across the organization and ultimately across markets. Strategic leadership, therefore, is not passive oversight. It is active stewardship. It requires the courage to act early, the discipline to act responsibly, and the vision to see beyond immediate disruption. In this environment, leadership is no longer about predicting the future. It is about preparing the institution to withstand it. Amid the disruption caused by tightening liquidity and constrained credit, a powerful counter-narrative is beginning to take shape. Opportunity is emerging where traditional structures are under strain. Financial disruption has historically been the catalyst for innovation, credibility, and competence. By strengthening balance sheets, improving transparency, and embracing measured innovation, adaptable institutions attract trust at precisely the moment when trust is scarce. What elevates this moment beyond a typical market correction is the competitive reshuffling it enables. Disruption lowers barriers for new entrants, challenges entrenched practices, and rewards strategic agility. The real opportunity lies not in predicting when conditions will normalize, but in preparing for a market that will operate differently than before. Those who recognize this shift early are not merely responding to crisis, they are shaping the framework of the next financial era. In an environment where disruption is unavoidable, Adaptability becomes the currency of success. And innovation becomes the bridge between uncertainty and long-term growth. So as we confront the reality of maxed out credit and tightening liquidity, let us not be discouraged. Let us be focused. Let us be prepared. And above all, let us be courageous. Because when liquidity freezes, vision must flow. When credit tightens, leadership must expand. And when crisis knocks, opportunity is already standing at the door, waiting for those bold enough to open it.